All right, could we be in for 3 days in a row of gains to kick off 2025? 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, Nvidia drops the mic at CES, unveiling new chips, software, and services. The CEO is going to speak to Bloomberg's Ed Ludlow later this morning.
And Meta makes major changes as it gets rid of fact checkers and elects Trump ally and media exec Dana White to its board.
And the pet economy, Bark, which offers everything from treats to toys to a doggy airline, saw its stock soar by 128% in 2024. We'll speak to the CEO next hour. All of that and more coming up. Let's take a look at where markets are trading right now. You can see green on the screen behind me. It's interesting to see the S&P 500 leading the big tech NASDAQ 100 right now. You have Nvidia shares up about 2.4% at the moment, but that's not translating into big tech leadership. But overall, we are a little bit higher. You take a look at the bond market, pretty quiet right now, of course, at very high levels. The 10-year Treasury yield trading at 4.63%. We do get some JOLTS data later this hour, I believe right at 10 a.m. That is a little bit of a preview for Friday's jobs report, and the long end will be something to watch.
Yeah, absolutely. And we're also seeing that yield high above the S&P's earnings yield. In fact, this is that chart. It's the biggest delta that we've seen to the downside since 2002. So more than 2 decades since we've seen the 10-year yielding this much more than the S&P.
Very hard to break apart that relationship between the bond market and the equity market, but certainly stunning chart. Again, Matthew Miller. Some stocks we're watching. We're watching Nvidia, of course. All eyes are on it this morning after it announced a new lineup of AI products to the pipeline. New gaming graphics, AI, desktop computer, partnerships to prepare for autonomous vehicles. That includes a deal with Uber, which is higher significantly today as well. Nvidia up 2.5%, Uber another 2.7%. In addition to yesterday's gains, of course, on some capital return. Micron up 4.6%. It's been tapped to supply a new lineup of GPUs, and that's just the start, Matt.
All right, yeah, absolutely. There's so much going on. A forecast for 1 billion humanoid robots from Jensen Huang, a forecast for 1.5 billion self-driving cars. And that's more than the global auto fleet now, right? We only have 1.47 billion cars on the road around the world, so...
Well, I guess in this futuristic society that Jensen Huang is imagining, the robots will drive the cars, right? Is that how
they're
it's gonna
separate.
Work? Well,
they're separate.
Maybe we're going to make a lot more people, but it was really interesting to see him deliver in the crocodile jacket, and interesting to see him spread the love, too. I mean, Nvidia shares, yes, they're higher, but really the action in Micron and Uber. You also have some smaller companies as well. Aurora also feeling the love today because this vision for the future that Jensen Huang has.
Even smaller, Arby, which is like a $300 million company.
I had to look that up, but they're going to need partners, and that's what you're seeing.
Good to spread the love. You look at just how much some of them are rising. Of course, Aurora is a lot down to the driverless trucking industry. So really a well-rounded vision, a little bit of something for everybody. I know, Matt, you were kind of looking earlier today at a chart that showed just how much gaming has compressed. As a percentage of its total revenue. Data centers just building, Microsoft still being the largest component of the revenue for Nvidia if you look at SPLC.
Right. Back in 2022, way back then. Remember the end of the pandemic?
Barely.
Gaming was still the biggest chunk of Nvidia's revenue. Look at the sales breakdown for 2025 estimates. And gaming is just $12 measly billion of...
You think about the future there, too. I mean, right now, their biggest customer is Microsoft, but the next step is apparently rolling out these hardware and software to a larger swath of business and also government agencies. So, I mean, at least in Jensen Huang's world, the sky is the limit right now.
Let's talk about all this with a BlackRock Chief Investment and Portfolio Strategist for the Americas, Gargi Chaudhuri. She joins us here on set. Great to have you, Gargi, here at 731 Lex. I want to get to the premium that I was showing earlier for treasuries over the S&P, or even more triple B bonds over the S&P. But we can't ignore this massive Nvidia announcement. I mean, to some extent, it's self-hype right? But it's a $3.7 trillion company now. How much of a driver is AI and Nvidia going to be in 2025?
Good morning. Happy New Year. It's so great to be here with you all this morning. And your question is actually the crux of what we're talking about in our year ahead outlook that actually we published today. And one of the things that we talk about there is the continuous impact of AI and the way in which investors should sort of think about investing with that theme in mind is continuing to focus on large cap companies, continuing to look at the intersection of what we call growth and quality, because that has been the driver in 2024. And we think, at least based on our projections of earnings, that's going to continue to be the driver of markets in 2025 as well.
From a valuation perspective, how do you break from the pack and look outside of Nvidia to find better ways to look for gains? You're seeing the companies at sky-high valuations meet some resistance from investors. Nvidia being an exception, but you saw today Palantir being downgraded, for example. Worries about Tesla valuations. Are parts still looking a little frothy?
I mean, this has been the biggest concern for clients that we speak to across the US over the last sort of, I would say, 6 to 12 months, right? Even before this 25% return we saw last year, clients were concerned about valuation. So the one point that I'd make is, number one, it isn't just tech and comm services, right? I mean, obviously that was the story of 23. 24, you did have that broadening out. And I think that's a really healthy sign for the markets. Number two, I think thinking about growth is really important here, thinking about earnings growth. So yes, to your point, if you look at PE multiples, those are obviously at, we think 22% premium over the last 10 years. But what is important to remember here is we are seeing earnings growth. So when you look at the 6 or 7 largest names of the S&P 500, those are the ones that are growing at about 6 times the rate at some of as compared to the 493. So looking at quality, and we look at
But isn't that going to slow down drastically?
It's going
in 2023, I think the Mag 7 was earning 63 percentage points more than the S&P 493. Last year, it was like 33 percentage points more. This year, it's supposed to be 7 percentage points more. So that premium is contracting at a drastic rate.
It is contracting. And that's the point I was making earlier around the breadth returning to the markets and continuing to return to the markets, which is a good thing. And I think it entices more investors into broader swaths of the market, but it is still higher. And that's obviously now, and we've looked at earnings revisions over the last 1, 3, and 6 months. Those have continued to trend higher and perhaps continue to do so. So I think there are 2 points that we're trying to make here. Number one, there is that compression that is taking place when you look at just the top few names versus the rest of the index. And I think that's good for the markets, which is why we're focusing on things like quality. This is why we're focusing on things like a dynamic rotation fund. And then on the flip side of that, you're also continuing to see the strongest cash flow generators being in the large cap growth names.
Well, I want to draw this point out a little bit more because, Matt, you're talking about the compression that we're expecting in earnings. And if that's the case, the broadening out that you're describing, is it more of a catch down for some of these heavyweights that have been leading the market versus a catch up for some of maybe the names that haven't been participating as much?
I think this is a time, 2025 we think are going to be good for markets, but I think you have to be a little bit cautious about broad everything outperformance. And, when I think about what might not do as well in this higher rate environment, and I'm sure we'll talk about fixed income in just a little bit, but some of the catch down might happen in areas like small caps, frankly. We've spoken about that with you here before. We saw the everything rally in November. And then in December, we saw an unwind, especially in the small cap space. So we think focusing on, again, large cap, quality, and there are areas of cyclicality too. We're talking about banks and brokers, specifically within financials, which we think would benefit strongly from the continued steepening as well as the deregulation. Where can we see a catch down? I think the broad everything rally, small caps participating in that in a higher rate environment may not necessarily work.
Yeah, let's definitely go to rates because you do hear some investors saying, okay, we should take on some duration risk, but even the 10-year still is fluctuating and potentially with significant upside in yields. We've heard investors talk about 5%, 5.5%, even 6% on our various programs here at Bloomberg. But what if you look even further out? In the last month of last year, you saw a lot of finicky investors when it came to BlackRock's own holdings of longer-term treasuries into TLT. Popular trade early last year. You're seeing some money come back this year. How do investors feel 10 years out or more, particularly given there's a lot of uncertainty around fiscal risks?
Yes, absolutely, Sonali. And that is such an important driver of what we talk about in our year ahead outlook of fixed income. So not all fixed income should be painted with the same paintbrush. There are areas of immense opportunity within fixed income, and you saw that in 2024 as well. Something like a BINC that returned close to 6%. You saw the front end of fixed income having pretty decent returns, but of course the long end, and you talked about the outflows in TLT. We certainly saw investors moving away, getting a bit cautious about the lack of term premium in the very long end of the market. I think that continues, at least now, based on valuations. Despite some term premium coming back over the last month or so, I think there's more of that there. So fixed income, really attractive. Right. I think this year it's much more about income rather than duration. So keep your fixed income duration in the sort of front end to belly, avoid the long end, and then think about income within high yield, within CLO.
I will note that TLT still took in nearly $5 billion last year. That wasn't, of course, the $24 billion that it saw in 2023, but still people looking for pain in the bond market going into that long duration. But I am curious when that flips. We talk to Rick Reeder every month on Jobs Day. He's still happy to sort of sit shorter in the belly. What do you need to see for people to really feel more comfortable stepping out?
Do you mean stepping out all the way to duration. The 20-year part of the curve?
Well, maybe
or
even
maybe
the 10-year.
Yeah, I like the 20s, Katie, as you know.
You're the only one.
Look, I think a few things that we have to remember. There are investors that even now, insurance investors, pension investors that are fully funded, that are going down the glide path and looking for protection in the long end of the curve. And obviously at 4.8%, that to them may be attractive. But we think actually being in the front end and looking at income is a more attractive opportunity. For investors writ large, I think, we can certainly see some more term premium. We're just now normalizing back a little bit. Historically, if you look at where the term premium has been, even if you look at just the ACM numbers, they've been about 50 basis points or so higher than here. Am I saying we're going to immediately rise 50 basis points in the 10-year part of the curve? Maybe not, but that could happen. The other thing that I think we need a little bit of certainty on is just what's going to happen with the fiscal picture. I think we're going to hear more about that as the inauguration takes place, etc. But I do think this unknown of more Treasury issuance coming to the market will keep the buyers away, especially if you can earn that in the front end.
Keeps the buyers away and drives yields to 5%?
I think it keeps the buyers away from the long end to other parts. Let's remember that there were 35 consecutive months of fixed income inflows into ETFs. Investors are buying fixed income. There's this amazing opportunity that they're recognizing. They're just not buying it in the long end. And I think it keeps them away from the long end into the belly of the curve, into the front end, into high yield, into securitized assets.
All right. Looking at the 20-year right now, 492.
Again, you're the only one taking a look that has that loaded.
Coupons. Gargi, thank you so much for coming in. Fantastic to hear from you with your experience. I know you ran a trading desk, bond trading desk for a long time as well. Gargi Chaudhuri there from BlackRock. Coming up, more on Nvidia's blowout presentation at CES and the snakeskin jacket driving many of today's stock movers. It's really shiny.
Or is it crocodile?
This is Bloomberg. Getting out of high interest, look at what's making headlines around the world. Mark Carney, the former governor of the Bank of Canada and the Bank of England, said he's considering entering the race to replace Justin Trudeau as Canada's prime minister. Trudeau announced yesterday that he's stepping down as the leader of the Liberal Party. He'll officially leave as prime minister after the party chooses a new leader. Carney serves now as chair of Bloomberg LP. Jean-Marie Le Pen, the founder of France's National Front and architect of the country's far-right movement, has died at the age of 96. Le Pen ran for president 5 times, sparking global attention when he made it to the second round of the 2002 presidential election. Although his daughter assumed leadership and kicked him out of the party to broaden its appeal, the party he founded is currently the most popular in France. And Getty Images is agreeing to acquire rival stock photo provider Shutterstock in a deal that would create a combined company worth about $3.7 billion, including debt. Once the merger is complete, the company will be named Getty Images Holdings. The deal brings together 2 of the biggest providers of licensed visual content in the U.S. as AI upends the content creation market. Sonali?
And we've been talking all morning about Nvidia's announcement of new chips, of software, its relationship with different automakers, and of course, it's holding on to its gaming business but expanding far beyond. We're going to bring in Caroline Hyde now of Bloomberg Technology to talk about the download from CES, but also to talk about how important it is. You look at Nvidia right now, you look at the importance of Microsoft in its client base. Then you get to Meta, then you get to Supermicro. These are large consumers for Nvidia. They're talking more and more about automakers now. How important is it for Nvidia to broaden its base of customers?
It's crucial, and therefore it paints a vision of the future. And he did that with aplomb, with his signature leather jacket yesterday, and reiterating every point 3 times. This is about a sprinkling of everything for everyone. Autonomous vehicles, they've got it. Robotics, they've got it. Have a vision of more than 1 billion autonomous robotics in the future. You're talking 10 million autonomous industrial units out there. Manufacturing is going to be automized here overall. And autonomous vehicles, don't even get me started, at least 1 billion of them. That is why you've got Toyota surging, Uber surging. They're coming on as partners. They're going to be using and adopting the technology or working alongside Nvidia. But when it comes to the future moat building, this is what analysts love. This is why 70 say buy the stock, 0 say sell. They're all really liking the future proofing of their technology. But in the here and now, they say that the Blackwell is being ramped up. They're at full production. So people like that here and now take as well.
I have a lot of questions. One being, of course, what animal the leather was made out of. I don't expect you to answer
Maybe it wasn't
that.
even an animal. Maybe he's peta-proof.
That's true. Maybe
Ask his wife and daughter. They're the ones who choose his fashion, he said.
If I ever am in a conversation with them, I will ask. Also, who is going to drive all of these vehicles? Of course, these autonomous vehicles. But also,
well, no one.
No one.
No one drives that. That's the point.
Oh, no. Yeah, well,
There's
anyway.
no wheel. There's no pedals. It's just...
Yeah, but do we need that many cars? Who's going to ride in them? In any case, I want to talk more about future-proofing because everyone is gunning for NVIDIA's lead here, especially in the chip industry, but also in some of these applications as well. I mean, how front and center do you think that is for Jensen Huang as he paints this vision?
Yeah, he doesn't want you to just think, oh, goodness, they only depend on Meta. Microsoft, which I have to say, Microsoft's $80 billion commitment to AI data centers has helped his stock yesterday. It pushed it to a new record high. It's on set for another set of growth numbers today as we hit yet more records with Nvidia. So it is important that Microsoft, Meta, Amazon are all still there, but it's broadening out for how they can become more important to governments, more important to other companies. And this is why we spell the future of actually getting into the PC area. $3,000 for a PC if you're an AI developer. Gaming, going back to their roots. This is why they're so integral to artificial intelligence and generative AI, is because the GPUs used for gaming. He's unleashed a whole new GeForce series that's going to be updating, improving imagery there. So I think it's just about being broader. And again, this isn't just hardware. This is software, this is services, this being ubiquitous to anyone who wants to be in on the generative AI game.
I started in this career covering telecoms, media, technology.
Only place to start.
At the time, in 2000, right, Nokia was the absolute leader of the smartphone market. Nobody else really even made them. I don't think it's a great comparison, but it's one of the only I can think of where one company ruled the roost and then competitors came in and chipped away until it was insignificant. Are there competitors to NVIDIA at this point? Are there any that are a real threat?
Well, there are people who are getting in on AMD and Broadcom. If you speak to the investors that come on our show day in, day out, they are ensuring that they're not just exposed to NVIDIA, but they are trying to see how AMD can build a market share when it comes to AI accelerators, that we will see Broadcom be able to actually build AI chips for the likes of Amazon, who wants to make their own chips. But you get Amazon AWS CEO on, and he's the first one to say it's and NVIDIA, not instead of Nvidia. Everyone feels that they are integral and everyone else is being beefed up elsewhere. And remember, they are so integral to the rest of the chip ecosystem. Micron today likely to power up about 6% because they're going to be providing the memory that goes into the Blackwell products and the future chips coming from Jensen. So I think he does need to show at the moment that, look, they're not the only game in town, but they're the dominant game in town. And they have been why they're $3.6 trillion in terms of market capitalization. Absolutely. And Nvidia shares, I believe, hitting another record high today, or at least on track to, of course, a few minutes away from the opening bell. Ed Ludlow is sitting down with Jensen a little bit later. He can ask him about the leather jacket. Perfect. We'll put it in. Perfect. Well, that is the perfect segue, too. Caroline Hyde, really appreciate you stopping by. A huge B-Tech coming up today, coming up at 11:30 a.m. Bloomberg's Ed Ludlow sits down with Nvidia CEO Jensen Huang for a wide-ranging interview at CES. Don't want to miss that one.
It does appear to be Bloomberg. Crocodile.
Really?
Yeah.
Wow. Confirmed, perhaps, crocodile. This is Bloomberg. All right, welcome back to Open Interest. Green on the screen just minutes ago until the bells ring. You can see the S&P 500 up about 0.3%. Big tech not in the lead right now, even with Jensen Huang's mic drop moment at CES yesterday. The Nasdaq 100 up about 0.2%, even with Nvidia poised to open at a record. You take a look at the small caps, also higher by about 0.4%. Of course, we're coming off a big day of gains yesterday, even though we did close a little bit below the session highs. Still, a lot of momentum in this market to start 2025. Now, coming up with less than 4 minutes to go until the opening bell, we'll discuss the market moves with Rebecca Patterson. That conversation coming up next. This is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We are seeing futures rise across the board. So if we hold these gains throughout the trading day, it'll be the third day in a row of gains, really to kick off the year. S&P futures up 1/3%. NASDAQ futures, interestingly, Katie just pointed this out, not leading the way, only up about 0.2, almost 0.25%. Russell 2000 futures up 0.4. You hear the opening bells on the New York Stock Exchange. It's Pursuit, nothing to do with my podcast, Hot Pursuits, which is out every Friday with me and Hannah Elliott. Down at the NASDAQ, because of apparently it's Wellness Week, I did not know, and I haven't been very well this week. Aura ringing the opening bell, the very popular ring that measures a whole bunch of different life metrics. Now, in terms of the major indexes, let's get over to a Garmin girl, Katie Greifeld, not wearing an Aura ring, but keeping track of the markets for us. Katie?
It's too clunky, and also I like real-time data. I can tell you my heart rate right now, which I won't. Let's take a look at these averages, because you can see green on the screen. As Matt mentioned, the S&P 500 building on its momentum early in the week, but still a good week for the S&P 500. Same, too, for the NASDAQ 100. Of course, we heard from Jensen Huang last night. That is boosting Nvidia today. It's boosting the benchmark a little bit, maybe not as much as you would expect. We have some weakness in Tesla, etc. But even still, big tech up about 0.2%. Your early leader, and just by a hair here, is the small caps. The Russell 2000 up about 0.4%. But my producer is saying, move on. Let's get to Nvidia. You're taking a look at a 1.6% rally right now. And if you take a look at this week so far, shares have been surging in anticipation and now after the fact. That's after CEO Jensen Huang unveiled a new lineup of chips, software, and other services, of course, help protect his company's lead in the AI revolution. Over the past 2 days, up 1.8%, Sonali, but it hasn't seen a down day yet in 2025.
And you're watching Nvidia also sharing the love here. Some stocks that are moving off of Nvidia's announcement. Micron. It will supply chips Nvidia unveiled for its suite of upcoming AI products. Micron up about 3.5% as the market opens. And Uber, because Uber and Nvidia are partnering to drive the company's autonomous efforts, Uber up about 3.7% as the market opens. Aurora Innovation, a much smaller company, but up almost 50% as the market opens, because it's going to be helping with the self-driving technology for the trucking industry. From cars to trucks, Matt, everything is going to be driven via robot.
Yeah, exactly. Well, the robots, though, I'm pretty sure in Jensen's version of the future, the humanoid robots are separate. They're not in the driver's seat.
I know, I want to see them in the driver's seat.
Yeah, I get it.
Psychologically, I would feel a little bit better.
I get it. Tesla has some self-driving capability, and it is moving lower after the U.S. added battery supplier CATL to a blacklist of firms labeled Chinese military companies, or firms that work with the Chinese military. The list now includes 134 companies, including Tencent, but Tesla taking a leg lower on an up day on those concerns. You can put a Tesla into full self-driving.
Right.
You don't need a robot, and my buddy Alex Roy just did that and drove from New York to California. Have I mentioned?
Yeah, you've mentioned it a few times. We still have never met this man, but
I'm going to bring him in. I'm going to bring him in.
Yeah,
he sounds
maybe
like
after the next trip.
An electric character there, so hopefully we'll get to meet him. But in any case, we have another electric guest sitting with us right now. Her name is Rebecca Patterson. She is Bridgewater's former chief investment strategist. Rebecca, it's great to see you.
Good to see you guys too. Happy New Year.
Happy New Year. Let's talk about the fear and loathing going on right now when it comes to the long end of the Treasury curve. A lot of caution when it comes to that rise that we're seeing in the 10-year yield and beyond, and a lot of question marks over what it means for the equity market. How are you thinking about that dynamic right now?
Yeah, I think that the level of the 10-year yield can matter psychologically short term, but the much bigger deal is what's driving the yields. If yields are going up because we have better long-term growth prospects, and that could happen from deregulation, productivity enhancements, et cetera, then you can have Treasury yields up and equities up. It's all good. But if Treasury yields are rising because of term premium, because of inflation worries, because of supply concerns and maybe demand from foreign central banks not meeting what's needed, then you can have higher yields, and that can be a bigger drag on equities. So I think this year we have to do more than just watch the yield and the trend. We have to get under the hood and keep an eye on tips, break-evens, what inflation expectations. We have to keep a close watch on term premium. I would bet in the next couple months, you guys are going to have a term premium tracker on the Bloomberg terminal that we can all go to with one click or something.
We have been looking at BBB bond yields versus the S&P yield. We have a long-term chart, actually, that I think is really interesting. Check it out. This goes all the way back to the early 90s. But right now, we're seeing the biggest delta between the S&P 500 and BBB yields since 2008. I mean, aren't equities insanely expensive at this point?
Well, I mean, we all see the PEs, right? We see the valuations. They are high relative to history, relative to the rest of the world. For now, they're being supported by earnings. And I think the high valuations mean that pullbacks are easier, disappointment is easier, but for it to turn the trend on a sustained basis, I think we also need to see either a real crack, a move higher in yields that's sustained and a big deal, and or a fall in the consumer. And right now, the consumer is still resilient. It's mainly the higher end and middle income consumer, not the lower income, but overall, the consumption growth is running around 2.5%. That's resilient. So that's going to justify that valuation and keep the market supported for now. The other thing I think we have to mention is the private sector stimulus we continue to see from the tech space. I mean, this year and next year, forget Nvidia. The rest of the Mag 7, $250 billion a year for the next 2 years in CapEx.
Yep.
And that's supporting the whole economy, not just those stocks in Nvidia.
I want to go back to that chart because I always wonder about measures such as this. Of course, comparing the earnings yield to a yield on whether it be, the ag or in this case, a slice of the corporate bond market. Is anyone making investment decisions based on a chart like this alone? It looks great on screen. I love looking at it.
Alone? That's not fair to say.
No, but I'm wondering, when you compare asset classes, would something like that, a measure like that, make you rotate from bond or out of stocks into bonds, or how do you actually view a measure like that?
Yeah, I mean, I think most investors today are going to have a dashboard probably built on something like Bloomberg.
As they should.
Of course. that's going to have a whole host of indicators, and they're going to give them different weights and then pull all that information together, aggregate it, and that's going to give them a reading that says, you know, be careful, it's a yellow flag, or red, okay, it's over, it's time to start paring back. So I'm sure this measure is being considered. The question is, how much weight is it given versus other factors? You know, what we saw in the 70s and 80s is that bond yields drove the market. We saw it again in 2022. But for most of the 90s and later 80s and 2000s, it was earnings that drove the market because we were basically zero rates. Bond yields weren't moving, they didn't matter. So the question for me today is, forget 2023, that was earnings, 24 earnings. Is this going to be another year where bond yields are the dominant driver? And I think there is a decent risk that it is.
In 2022, of course, we had Torsten Slok over at Apollo calling out that kind of really dangerous moment where you can see both bonds and equities losing steam. You know, I want to pull up this note here also from Jason Furman, because if we think about the factors here that are driving those long-term yields, it's not only growth, it's not only inflation expectations, but also some of this has to do with worries about Fed independence.
Yeah.
And Jason Furman here over at Harvard makes this case that you would have less of an inflation bias, and empirically data shows that.
Yes.
Should the Fed stay independent? A day ago, we saw Michael Barr announcing that he would be stepping down from the vice chair of supervision role, really kneeling here to political pressures. What does that mean? And is Fed independence going to be a real story going into this year as we think about their role?
I think that's an absolute, Fed independence is a risk we're going to have to keep a close eye on. You know, I think the Fed in that decision, my guess would be that they think we need to focus on our dual mandate, growth, inflation. We don't want this to be a distraction, right? So he wanted to get ahead of it and help the Fed do its job. The risk, though, to your point, is that it's perceived as preemptively giving into politics, which the Fed should not and has not done historically. So I think there's a slippery slope here. And I was surprised that he made that decision without actually being told, you got to go.
By the way, we talk about all the time whether well, the market, I guess, is discounting tax cuts and deregulation much more than it is discounting mass deportation and tariffs. Right. Even if Trump pushes back, like yesterday on Truth Social against the Washington Post, when he said, no. When I say universal tariffs, I mean universal tariffs. We're not paring them back.
Right.
The market doesn't believe that.
Right.
Isn't that because, I mean, Sonali and I were talking this morning, Trump essentially won the election because of the inflation under Biden. He can't allow the same thing to happen over the next 4 years, or else the Republicans are out again.
I think that's right, that if inflation resurfaces, it's sticky or starts going higher, especially for things like groceries and energy costs, which hit the lower-end consumer hard, voters who've supported Trump. That's going to be a big challenge for the Republicans in 2 years and in 4 years.
True.
I wouldn't be shocked, though, if it happens that the administration in power blames some other force for it happening and doesn't say, oh, it's not us, it's whoever, fill in the blank. Both parties do that, but I would expect that to happen if it happened under Trump. I do think Jason Furman's right that reducing Fed independence or the perception of independence could be inflationary. The tariffs, if they happen, are going to be inflationary. Fiscal policy is going to be inflationary. I mean, that's what brings me back to this view that this is going to be the year where we all have our little term premium trackers and we're watching the 10-year yield.
Well, we'll have to work on building our own. Rebecca, it's always great to see you.
Thank you.
Really appreciate your time. That is Rebecca Patterson. Now, coming up, Meta will end third-party fact-checking. We'll take a look at the company's changes ahead of the Trump administration, many just in the past week. This is Bloomberg.
All right, breaking news here on the CFTC. The chairman, Rostin Benham, will step down. He plans to depart on January 20th. He said this in a statement that his final day with the department will be February 7th. So he's resigning on essentially the inauguration day. He's going to actually leave on February 7th. It's not a huge surprise. Right. He had campaigned to be the lead regulator on Bitcoin, as you well know, Sonali, because you anchor our cryptocurrency coverage. And he was an advisor to Debbie Stabenow, a Democrat from Michigan,
Right.
So wrong side of the aisle.
Very, very against certain things like election betting in particular. And that's something, obviously, that was a battle he lost, has taken off, may take off even more. Gary Gensler also stepping down. Gary Gensler also soon talking this week to our David Gura as well. So these exit interviews will be interesting to watch and see what the legacy will actually be.
All right, a lot to look forward to there. Let's get to top calls now. Some of the analyst action in focus this morning. And first up, we have Lululemon getting upgraded to buy at Bernstein. The firm says that the company's Americas business has bottomed and is poised for a modest recovery. The analyst also cites an improvement in consumer sentiment, especially from higher income consumers. Next up, Oppenheimer upgrading the Cheesecake Factory to a buy, also giving it a street high price target. The analyst over there says that the outlook for restaurant fundamentals is improving and that he expects a breakout performance this year from the dining chain. Shares up about 3%. And finally, we have Apple getting downgraded to a sell by MoffettNathanson. The firm cites its high valuation, antitrust overhang, and its weakening position in China. The analyst says that the stock is, quote, decidedly unattractive. You can see shares right now. I'm going to go ahead and call that unchanged, Matt.
That is aggressive. There are only 4 sells of the 60 analysts who rate Apple. So MoffettNathanson coming out with a big call. Now, let's talk about one of the other Mag 7 companies that's making a lot of moves ahead of the incoming Trump administration. Meta is announcing sweeping changes to its social media platform, Facebook. It will end its third-party fact-checking program and move to a community notes model similar to the one that Elon Musk's Twitter, or X, uses. The company also ending restrictions on topics like immigration and gender identity. This comes one day after Facebook, or Meta, announced UFC CEO and Trump buddy Dana White will be on the company's board. Here with more is Bloomberg's Michael Shepard. And Mike, this all comes on the heels of a trip to Mar-a-Lago for Zuckerberg, $1 million donation. They're really ingratiating themselves with the new president.
These are a lot of steps being taken in very short order to make sure that they are on the good side of the incoming administration and its allies in Congress. The Republicans will be controlling both the House and the Senate, and that will give them power also to conduct investigations and hearings that would bring people like Mark Zuckerberg to Washington to face some public scrutiny and perhaps in an uncomfortable fashion. And this is in addition to all the possible regulatory exposure that they might fear under a Trump administration if they were not in good graces with the incoming president. And keep in mind that they have not been in great favor with Trump. Facebook and Instagram banned the former president from their platforms over the January 6, 2021 attack on the U.S. Capitol by Trump supporters. And that really set off Donald Trump. He has, even as recently as the 2024 campaign, singled out Facebook as what he called the enemy of the people. So these moves by Zuckerberg are really aimed at an audience of one here, and that is Donald Trump.
Well, when you look at Zuckerberg's message as well, announcing these changes, one thing that was fascinating to me was the way he treated the traditional media versus the way he treated his own fact checkers. He really highlighted political bias even within the people that were dealing with the policies of the past. What does that mean for the way that the Trump administration converses with the American public? Is there going to be a lot of shifting in who's in charge?
Well, it's a great question, Sonali, because we have already seen the attempts by Republicans like Trump and their allies to shift around the traditional media that we have known for decades and instead try to communicate through different platforms, not only Truth Social. Even during the 2016 presidential campaign, then candidate Donald Trump used X, then known as Twitter, to great effect, really rallying support and finding an audience that was willing to not only take his message, but act on it. And they feel like they get a better say when their speech is unfettered. And this has been a common complaint of Republicans that conservative viewpoints have been shackled by the kind of content moderation that Facebook is replacing with these moves now. Now, it's important to note that this is applying only to the U.S., as far as we can tell, and it will not necessarily apply in Europe, although there are pressures on the whole free speech issue there, too, being led by none other than Elon Musk, who has complained that the European Union and the UK have been threatening to or have already imposed shackles on users' ability to communicate freely on his X platform, which he bought back in 2022. And he has really tried to turn it into this no-holds-barred space for free speech.
Well, an interesting move, of course, by Mark Zuckerberg and the new global affairs officer, Joel Kaplan, who just got the job. Bloomberg's Mike Shepard, great to get your insight. Now, coming up, Bridgewater announces job cuts as hedge funds release 2024 returns. That's next in our Wall Street Beat. This is Bloomberg.
And it's time now for the Wall Street Beat. We're looking at Bridgewater today because the hedge fund firm is laying off 7% of its workforce, or about 90 employees. Bloomberg's Sridhar Natarajan covers all things finance for us. This is about 90 employees, and according to people familiar with the matter, the headcount goes back to where it was in 2013. They've had double-digit returns last year at its main fund. So is this a matter of performance, or is this a matter of just reshaping things? Is it just culling at the end of the year?
Even before we get to that, let's talk about the fact that the first week of January is the start of a new year, and the first news you get out of the world's largest hedge fund is 7% of their workforce is getting cut. Even more surprising, this has come through in many conversations in the roughly 12 hours since the story broke. The language they use all these yoga terms. We are here to be more flexible, more nimble. It's just a hard pill to swallow when you describe job cuts that way. But you're right, they've had double-digit returns. They are talking about making sure that they have the ability to continue to hire talent. So there's no indication here that this is Bridgewater going to rapidly go backwards. They claim they're still on the front foot and on the offense, and they will find ways to continue to make money. It just sucks if you're part of that 7% group.
I would imagine that investors would like to hear more like bodybuilding terms, like strength and raw power.
Getting swole.
Rather than nimble and flexibility.
I think that's probably true. Certainly those 90 would. If I worked at the firm, I might say, you know what, Sri, a lot of hedge funds that have done well have cut jobs this year, just like they do every year. It's a normal annual culling. This is how the business works.
This feels a little more than your normal culling, but that is true. On Wall Street, whether it's
the biggest hedge fund in the world with 90 people?
Well, if your total workforce is 1,300, so you have to look at the percentage size. So if you're cutting 7% of your workforce, it is still something. So I would still say it is more than your normal culling. But you're right. Across Wall Street, whether you're a big bank or a big hedge fund or a big private equity firm, you are used to this reality. All these firms like to jack up, Katie, when the times are good. And when things turn around, they want to make sure that they cut off the extra baggage, what they call cutting off the fat.
Even beyond that, I remember a conversation I had with Greg Jensen just a year ago, and they were saying, okay, they built a new machine learning fund. They're trying to add more technology talent. The texture of the talent is changing. A day ago, first week of the year, as you're talking about, Citadel, with that non-compete, expanding that non-compete, what does this all say about the future of talent? Because it's not like hedge funds are going out of vogue in this season.
Absolutely not. In fact, especially if you think about the multi-strats, there is just still a lot of demand out there. Yesterday, we had the story where Citadel was increasing its non-competes to 21 months. That's really roughly 2 years off the market. Yes, you're going to be paid through that period, but that is not to make sure someone has a stressful transition into their next role. It is to make sure that you don't want to leave the seat. It is to make sure that whoever's trying to poach you cannot easily grab your talent, because the war for talent is high. And it's not just this. You remember going into last year,
right.
All through last year, we were talking about the Millennium Jane Street battle over the two traders who jumped shop. So that war for talent will stay in place, and that will be a dominant theme this year, both in terms of these non-compete terms, but also in terms of the pay packages you'll see a lot of these shops.
Sridhar, we're up against the clock. It's great to see you. Happy New Year. That is Bloomberg's Sridhar Natarajan.
Namaste.
Coming up, a conversation with Goldman's Jan Hatzius. Don't go anywhere. This is Bloomberg.
Oh, my.
All right, we are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. We're taking a look at markets right now, just a few seconds away from that JOLTS data coming out at the top of the hour. You can see heading into it, we do have a rally underway, but the NASDAQ 100 has flipped negative, despite the gains that you saw in Nvidia, of course, that fading. Meanwhile, we do get the numbers coming in for JOLTS. Job openings coming in stronger than expected by a margin here. You can see the 10-year yield moving higher in response as we do see strength in the labor market.
Yeah.
Or rather, at least the jobs openings coming in hotter.
More than 8 million job openings there. It seems to be still a pretty strong labor market. Obviously, we get the all-important non-farm payrolls number on Friday, and I know this is the part of the equation that a lot of people are paying attention to now, not as much the inflation situation.
Yeah, absolutely, but you have to understand, does one lead to the other as well? I think if bond yields move higher because of growth, a lot of investors are saying that the equity market can withstand that. But we're going to talk about all of that with our next guest. We're going to bring in Jan Hatzius. Of course, he's chief economist at Goldman Sachs. When you think about the balance of risks right now, we've had strong economic data keep coming through the pipe for the last couple of weeks. Are you more concerned about jobs or inflation?
I'm pretty optimistic on both. I think we're set up probably for another year of pretty strong growth. I mean, we're at 2.5% for this year, again, and above consensus forecast, not by as much as the last couple of years, when I think people were really unreasonably pessimistic about recession. But I'm still a bit more upbeat. But at the same time, I think inflation can come down and can continue to come down. While the JOLTS number this morning is a little stronger, we've clearly seen a rebalancing in the labor market, and utilization is now a bit lower than it was back in 2018 or 2019. So that's a pretty constructive environment, both on growth and on inflation, in my view.
First of all, I want to point out that we did see a turnaround in the S&P 500. So we were looking at gains, now we're looking at losses. It's only a couple basis points.
Nvidia's down almost 3%. Nvidia's flipped as well.
That is huge, and I can't imagine how JOLTS drives Nvidia down 3%. But maybe I'll figure out a way to make that connection.
You'll get there.
I'm wondering about your take on the Fed, because you expect, I think, still 3 rate cuts this year. And I don't understand exactly why the Fed needs to cut. Rates don't seem very restrictive. We have 2.5% growth, I think, is your forecast for 2025. We have an S&P 500 that's up another 24% after a 24% gain. Unemployment is very low, still much lower than the historical average. Why does the Fed need to continue to cut?
I'd say 2 things. One, the funds rate is still quite high. We're still 100 basis points or so above many people's estimates of the equilibrium funds rate, or we're in our case 75 basis points. It's a little more than 100 basis points in the Fed's case. So I think there's a presumption that if nothing else happens, the funds rate's more likely to come down just to get back to something closer to equilibrium, at least as long as inflation still trends down, which is our expectation. And number 2, we have seen a labor market rebalancing, and in fact, some signs of weaker labor market activity, certainly on the hiring front. We're also looking for a somewhat softer employment number on Friday. Obviously, that's only one report. We'll see what it prints. We're at 125 for payrolls, and we think that the unemployment rate might edge up to 4.3%.
Right.
And 4.3 is low, but it's not super low. It's no longer in the 3.5% range, and it would be a touch above the Fed's estimate of the natural rate of unemployment.
So just to clarify quickly, so 3 rate cuts in 2025, that would be normalizing. It wouldn't necessarily be easing from the Federal Reserve.
Yeah, that's a question of terminology, but I think you could put it that way, that it's normalizing rather than really easing.
Okay, so maybe a distinction without difference, but words matter here, Jan, and we haven't talked about Donald Trump yet. And it feels like when you talk about the Fed, when you talk about the inflationary outlook, even when you talk about growth, you have to talk about tariffs. What is your base case for tariffs right now? And I know it's hard before the man even gets into the office, but what are you expecting there?
We're building in tariffs on China, so a 20 percentage point increase on average in U.S. tariff rates on China. and we're building in auto tariffs on the European Union and Mexico. Beyond that, and that gives us, a modest negative impulse to growth. I mean, by itself, there are some other changes in policy that are more growth positive, but a few tenths of growth. And we have about 3 or 4 tenths of additional inflation in 2025 because of the tariffs. With that, we still have inflation coming down from 2.8% now to 2.4% by the end of the year, but we'd be very close to 2% if it wasn't for the tariff impact. So it's a sort of mixed impact. I think markets have very much focused on the fact that, you probably will see somewhat more inflation in the short term. They've taken that as quite hawkish, but it's double-sided. I mean, you have it, on the one hand, you have an inflationary impact. On the other hand, there are also some risks to markets if we were to see a more aggressive tariff posture, which of course is a risk. We don't know, as you said.
I would also say, we were talking about all the data that's coming out this morning. Won't put you too much on the spot. I know you're right in front of us, but I want to point out that the ISM services prices paid has also been rising. And that's also leading a lot of this movement in the yields as well. You're also seeing traders wipe out the possibility of a full Fed rate cut before July. So tremendous spread in the market right now and tremendous uncertainty. When you look forward, I think something that is confusing about the longer end of the curve, not even the bottom end, is when you're thinking about how the Fed doesn't just treat the Fed funds pricing, but the longer end of the curve. Quantitative tightening, running off the Treasury portfolio, how is that going to change the dynamics? Because you do risk, don't you, a tantrum?
I think the quantitative tightening or the normalization of the balance sheet, I mean, the idea is to have that very much in the background. It's not an active instrument of monetary policy. I don't think it's had a major impact. They're being very, very careful. They might still let it run for quite a while, but at a very, very slow pace. They don't want to cause any dysfunction in the markets. I think the key instrument is still going to be the funds rate. And on the funds rate, you're right. Markets have really moved pretty far away from additional easing or normalization or cuts. I mean, back in September, markets were pricing a terminal federal funds rate of 270. Now, we're more than 100 basis points above that in terms of market pricing. And I think markets have moved too much. They were way too aggressive on pricing rate cuts back in September. But now I think there's some room for pricing more.
Interesting. So maybe the market overshot in both directions. I want to stay on the long end of the Treasury curve because it's just fascinating to see the long end rise, even as you have the Fed cutting rates. We talked a little bit about QT here, but how would you explain the rise that we've seen in the 10-year Treasury yield? 100 basis points since the Fed cut rates. What's actually going on there, would you say?
I think it's a combination of two things. One, and maybe most importantly, is what I just talked about, namely that markets have really revised their expectations of where the funds rate goes
even
in the
for the long
term.
end.
Well, that has an impact, of course. If markets think now that the funds rate is going to be at 4% rather than 270, of course that gets incorporated into the first several years of the term structure. So you're going to have an impact on the long end. And then I think number two, the term premium is rising. This is the excess return that investors can expect for holding 10-year securities as opposed to overnight. And that's been rising for, I think, a variety of reasons. Concerns around fiscal policy are certainly part of that. And I think that's been a trend that we have been seeing and may continue to see. This could be a more secular trend where, as the debt to GDP ratio continues to rise, you get a little bit of additional term premium that creeps in.
I was listening to your Odd Lots podcast with David Kostin, which I thought was really great. And you're the chief economist, and you're also the head of the research globally at Goldman Sachs. You seem, though, to focus more on the markets in the shorter term. And I'm wondering, at least in that podcast, and I'm wondering if you step back and look at the world. What's happening we were just talking about France, how the Populist Party is the most powerful there. You just saw Kickle get a pathway to lead Austria and the first far right-wing government there since the Second World War. The AfD is very popular in Germany. We have Trump coming back here. What does this populist shift do to your economic outlook for global growth?
I think broadly speaking, it increases the potential risks around any baseline scenario that's more driven by the economic fundamentals themselves. I think there is more risk of exogenous shocks from fiscal policy and from trade policy and just from conflict between countries, whether that's in the trade arena between countries that are, military and geostrategic allies, or more significant military conflict in other cases. And obviously there are a number of examples of this. So if I look back over the 27, 28 years that I've been an economist working in markets, I put a lot more weight on these exogenous shocks now than I did when I started my career. There are many different aspects of that. I think a lot of the populist backlash in Europe that we're seeing now is certainly an aspect of that, but this is a conversation that could go on for a long time.
What about internal politics? And I've got to say, Jan, from tariffs to politics, we could go anywhere with you. But I do want you to weigh in one of the larger stories of today. You had Michael Barr stepping down as the vice chair for the supervision for the Federal Reserve. You have a lot of chatter around Mickey Bowman around taking that spot. What does that mean in terms of the composition of the Federal Reserve? You have one of the largest hawks on the Federal Reserve being put up for a different type of position. She has been very critical, let's say, of some of the bank regulations. What does this mean for the impetus to raise interest rates?
By the way, it's not unrelated.
Higher?
It's not unrelated to my question, right? Because we were talking about Jason Furman's tweet. This is sort of bowing to the next populist government, and
investors are getting concerned, for sure.
I mean, for monetary policy, I don't think it's going to have a very significant impact in the sense that, the Board of Governors is fully staffed. Michael Barr has said that he is going to remain a governor. So, clearly Bowman has been more hawkish on monetary policy. I'm sure that's going to continue to be the case. The read across from that into what happens on the regulatory and supervisory front, I think, is going to be limited. Obviously, we've seen a big shift in terms of the political environment. That's going to have implications for regulation, not just in the financial sphere, but probably also in other areas like mergers and maybe energy regulation. And I think this is part and parcel of that broader shift in terms of the regulatory agenda.
All right, Jan, unfortunately, we have to leave it there. A real masterclass. Hope you come back soon. That is Jan Hatzius of Goldman Sachs. Meanwhile, let's get a check on these markets. Of course, a big reversal underway in the aftermath of both the JOLTS data, job openings coming in greater than expected, 8 million jobs in November, but also the ISM figures that we also got at the top of the 10 a.m. hour. ISM services prices paid coming in at a 22-month high. You can see the ripple effect in markets right now. The S&P 500 now down by 0.3%. The NASDAQ 100, Nvidia also taking a leg lower. All of that weighing on the NASDAQ 100 down about 0.7%. The small caps under pressure as well as bond yields just spike in the aftermath of this data. Coming up on this program, U.S. dock workers in talks for new labor contracts as the threat of a major port strike looms. We'll speak with the CEO of logistics company FreightWaves next. This is Bloomberg.
The International Longshoremen's Association and the U.S. Maritime Alliance are meeting in New Jersey today. The dock workers and their employers have just over a week to hammer out a deal on a new labor contract or risk halting roughly half of all of this country's container volumes. Joining us now is the CEO of supply chain and logistics company FreightWaves, Craig Fuller. Craig, we'd love to get your input on this kind of stuff. And I think, as far as I understand it, all boils down to automation. The workers don't want high-tech machinery coming into the ports, and of course the employers do want that because it would make things faster and cheaper. How important really is this automation?
I mean, it's a really important point, if you will, both for the overall supply chain, the importance of automation. You know, the U.S. ports are arguably some of the least advanced ports in the world. China, a large portion of its ports are fully automated or large levels of automation. As a country, we have fought this largely because the ILA has prevented it. The longshoremen have prevented it. But it is a major point of contention. And it's something that they were able to achieve significant wage gains in the preliminary negotiation. And they decided to put off the automation discussion to finalize the actual contract until after the election, right before the inauguration.
Politically, it's a sensitive time, but also when it just looks at what the traffic looks like. If you think about the amount of traffic that has gone through particularly West Coast ports after the threat of more tariffs have come into play, the uptick has been meaningful. And port CEOs have spoken to us about how they believe that will continue going into this year. What are you seeing, and how does a looming strike threaten that?
Well, you know, the volumes have come in for a couple of reasons, predominantly because of tariffs, but also because of the potential of a strike. And we've been seeing that play out for, 6 to 9 months, really all throughout 2024 and well into 25. Port volumes have been near or above record levels for seasonally adjusted record levels. And so it has been really bullish in the international ocean container markets. And that volume continues to pour in as companies plan for potential disruptions or cost increases due to tariffs. And so that is certainly a factor. The strike is only one reason for that. The tariffs and the threat of tariffs is really driving a lot of it, as companies have pre-stocked inventory to avoid any potential surges in cost or geopolitical issues that potentially could pop up. So it is a major concern. The one thing that I would point out is that the union was able to get substantial wage concessions when they got the preliminary contract and during the negotiation. And so this is all, at least reportedly, about automation. The union is against any form of automation where the port operators and the international ocean container lines want to actually create some level of automation. What's interesting about this is President Trump has actually come out on behalf of the union and endorsed their position because he views it as foreign companies that are trying to put American workers out of work. And it's interesting how he changed the entire conversation away from automation versus non-automation to foreign companies versus U.S. labor.
How powerful is President Trump's influence on the Maritime Alliance? I mean, if he pushes them with the power of the bully pulpit, does that weigh heavy?
I think quite substantial. You know, the U.S. Maritime Alliance is actually made up of foreign companies, largely. So these are foreign companies. These are a part of the international container markets. The vast majority of them are actually foreign-owned companies. And so it's in their interest to really upset the Trump administration, because I don't think anyone wants to be on the wrong side of Donald Trump's vitriol if he decides that he wants to do something. And they've enjoyed staying out of some antitrust. They're exempt from U.S. antitrust law. A lot of that could very well be overturned if they get it on the wrong side of Donald Trump. So I think they've got to play their cards very carefully. And his siding with labor in this argument, I think it actually means that a strike is far less likely, because I think the U.S. Maritime Alliance is going to be very careful how far they push it. Now, having said that, I don't think the Trump administration wants a strike on their watch. And so one of the things that you have the public positioning of what we know, but every single supply chain strike, there's a lot of conversations that are taking place behind the scenes that we're not privy to, nor should we be, that's trying to resolve and find a middle ground.
Craig, great to get your insight as usual. We'll check back in with you as this strike progresses. Craig Fuller there is the CEO of FreightWaves. We are looking at a market that has continued to fall after the ISM prices paid showed a spike in the last reading. We now have a down market with the S&P selling off 1/3 of 1%, the NASDAQ down almost 0.75% as Nvidia takes a 3% drop with the rise in rates that came after that prices paid number came out. We'll continue to follow these markets for you. This is Bloomberg.
Well, the pet economy boom is still going strong. Bloomberg Intelligence says that the industry is set to grow to $500 billion by 2030. One company is angling for a bigger piece of that pie, and their name is Bark. After 3 rough years in the public markets, the global dog brand, which offers everything from treats to toys to actually a dog airline, it saw its stock climb by 128% in 2024. Here with more, I'm pleased to say we have Matt Meeker. He is the CEO of Bark. Matt, it's great to have you back with us. And I want to talk a little bit about the competitive landscape here, because obviously you had a great year last year, but you think about your competitors in the form of Petco, in the form of Chewy. How do you stand out and how do you keep that momentum going?
Well, actually, we don't think of Petco and Chewy as competitors, but as partners. And Chewy, a relatively new partner here for us in the last year, with a fantastic partnership and a growing partnership. So it works really well where Chewy is fantastic at taking our products and products from other great companies and getting them to your home reliably, quickly, and efficiently. And they run a really good retail business doing that. And we're more focused on creating awesome emotional experiences and great products for your dog. So we're chocolate and peanut butter there.
Well, Matt, to follow up on that and just draw that out a little bit further. So, I mean, people think of Bark and they think of the subscription service mostly, and they think about basically getting those boxes directly from Bark. So when you think about the future, is the future more trying to get into Petco stores, for example, and on the shelves versus that direct-to-consumer experience?
It's both. It's both. We said about a year ago that we have a goal of moving from 12% of our revenue being in the retail or commerce channel to over a third. And we made great progress this year. Our commerce business will grow over 40% year over year, which in year one is really good progress. So it's both. Really, we want to be wherever the customer wants to shop. If they want to buy our products on Amazon because they have Amazon Prime, we're thrilled about that. If they want to buy them directly from us, we can do a little bit more with that. We can get to know you a little bit better, serve your dog more individually. But it's just great if you love Chewy and you want to add a toy to your upcoming food purchase, that's good with us too.
We just showed the stock over the last year. It's well over doubled, up I think 158%. Over the last 5 years, it's a very different story, and obviously that comes out of the pandemic when everybody was treating their pets to, I mean, that was all your disposable income pretty much, booze and pets.
Not your children.
Well, or children, I guess, if you had them then. Is there any way you get back to that, $15 a share? Was that was that just a strange time that we'll never see again? Or what are your hopes for Bark in terms of the stock price?
Yeah, I would say back then there was a boom around pets, as you're alluding to, and a lot of excitement around the stock and the sector overall. That's reflected in that price. And then we were a dirty word. We were a SPAC. We went public via a SPAC. And so that went from a very hot thing to a very cold thing. On both of those, you had pet and SPAC as very hot, and then they went to very cold. And so I think maybe the stock price was a little bit overheated, and today is very cold relative to the actual results we're posting and the outlook we have.
Speaking of results and outlook, Matt, what's going to be the biggest driver of that moving forward? You recently talked to investors a lot more about consumables, about your partnerships with Chewy, Amazon, Costco. Where's the next biggest leg of growth, and what are the numbers that support that through some of these other channels?
Well, you mentioned some of them in consumables where we're fairly nascent, and that's a big category in pet, obviously. The expansion into the commerce channel with Chewy, Amazon, and many brick and mortar retailers, including internationally. And then you go forward into those white space opportunities, which Bark Air would be one of those. There's nothing there, or there was nothing there. And that's well over year 1% of our revenue. We expect it to grow nicely in the year ahead. And we're filling the planes, and that means it's growing without burning much capital at all.
I am wondering, I mean, when you look at the future of Bark, would you be open to potential acquisition, either by you or Bark itself getting acquired? I take a look at your market cap below $400 million. You take a look at the performance and the momentum. I could see you as an attractive target.
Certainly, well, we're always happy to entertain those conversations or take those calls. I think we've got something really special in the brand and the relationship we have with our customer. And we're on pace to post our first profitable year. We have plenty of cash in the bank. We have a great plan in front of us. So there's not a big pressing need to sell the company, but for the right partner where the brand is sustained, sure, we're always open to those conversations.
I want to get back to Bark Air because for me, that's the most fascinating aspect of the business. Even if it is a small slice of the revenues right now, I had a great experience bringing my dog to Berlin when I moved there on United in business class. He was allowed a seat on the way back. When I moved back to the U.S. in 2022, they no longer allowed that. He had to fly under the plane, and I'm not going to say he died because of that, but he died shortly thereafter. I think a lot of people have had really bad experiences with dogs under planes. Do you see a lot of repeat customers? I mean, if someone flies a dog Bark from New York to Florida or New York to Paris, does that person come back and do it again and again?
Well, we do, actually, and it's only been 9 months here that or not even 9 months, 8 months that we've been flying now. So it's a relatively short amount of time for repeat passengers, but we do. And we just posted the second half of our 2025 schedule last week. It's filling up already, and a lot of that is repeat customers. So a really good start. And I'm with you. It's the most fun thing that I work on. I wish I had more time to work on that and not the rest of the things.
Looks amazing. Look at that. Look at that.
It's so fun.
Dog paradise. No cats.
It is.
No cats. Which, Matt, I'm a cat person, so I have some feelings about that. I won't air them on air, but I asked you this a couple months ago. I'll ask you again. Is Bark Air profitable? Are you losing money? Are you gaining more potentially in marketing buzz than you would if you had a different campaign? I mean, how is it working out financially?
It's working out quite well. We went into it. We thought we would invest a couple $1 million this year in the marketing behind it, in the operation. We had pretty modest hopes in terms of revenue, which we far exceeded. And we've been gross profit positive, which was not a small thing, since July, every month. And then we're right around break even for any startup, especially an airline, to get there in the first year, I think is pretty great. It's also not our goal, and we have a lot of things in the works that will lower our cost basis for the same operation that we're running today, and will definitely enhance the service as well. So the profitability side is working out really well. The revenue's growing great, and the thing I'm most proud of is it's almost 100% 5-star reviews. I think we've had 2 that were not.
Well, I think it's a great service to offer people who had few other choices. Matt, great to have you on the show. Hope to get you back. Matt Meeker there is the CEO of Bark of the box, Bark of the airline. I will say the Bark experience looks even better than the business class experience on United. I brought Steve there.
Yeah.
Newark to Berlin. It's a great leg.
Rottweiler, of course.
There's my my boy, my best friend, my Rottweiler, and he got a special meal. He got to watch the movie.
It's flat.
It's lie flat, which is more comfortable. He's got a toy. But I think the Bark experience looked even more appetizing, and I look forward. Would you bring Loki on the plane? Would you take Loki to Paris?
If he could stay in the cabin, yeah, I would. I mean, the reason we don't travel with him is I don't want him to have to go underneath the plane.
Oh my God, no, absolutely not. It must be so scary. In any case, Bark Air, we'll keep in touch, of course, with Matt Meeker, because what a delightful business that is. In any case, coming up, a story about transformation. The former Bank of America vice chair discusses the turnaround at Bank of America with David Weston. This is Bloomberg. All right, it's time now for our daily Wall Street Week conversation. And as we discussed yesterday, Bank of America faced a lot of challenges following the 2008 financial crisis. David Weston spoke with the former Bank of America vice chair about how CEO Brian Moynihan brought the bank back from the brink.
In financial services, we were in a near recession that was the likes of we had never seen before, and B of A had a million problems. And we had issues with regulators, we had issues with analysts, we had issues with clients and customers. Elected officials were questioning our viability, and the stock price was very low, and there were questions about the company in general. And this is what Brian Moynihan stepped into, and he stepped into it, I have to say, eyes wide open, because he had done almost every executive job in the company. So he was prepared. I think he was prepared in a way almost no one else could have been. And he was also willing, and he was certainly able. So this was a moment for this company, and he assembled a crew around him, an executive management team, and we were going to work 24/7 for what turned out to be at least a few years, and we recovered. But that was what it was like on day one for him.
We have some idea of what it looked like from the outside and how bad it looked, frankly, at the time. Did it look as bad on the inside, the situation Bank of America found itself in?
Well, yes and no. The thing was that we had acquired Countrywide, which was problematic. We had acquired Merrill Lynch, which was, at the moment, problematic. Of course, it turned out to be a terrific asset for B of A, but not in that moment. So it was difficult in that there was so much to do at one time. And what I mean by that is we had to decide what we were going to do in terms of everything from customer care, if you will, employee morale, dealing with elected officials, dealing with regulators, and then what businesses we were going to lean in on, and those that we were going to perhaps exit. So Brian is got a bit of the engineer in him, in that he is an exacting person. We laid out every line of business. We laid out every geography we were in. We looked at the international portfolio. There was nothing we didn't look at. And he had us looking at all of it and evaluating what was going to be a go-forward opportunity. And that's how we got to the 8 lines of business. And it's also how we determined those things that we would jettison and move away from, either by geography or by investments that we had. So that was all going on at one time, and the team was a true team. We met every day, and we worked through what we could do. I mean, I want to take that and then fast forward. Remember that this is a company that today, for the last 10 years, has earned in net income more than $15 billion a year, which makes us one of less than a half dozen companies in the country that can do that.
And that was Ann Finucane speaking with David Weston. You can catch Wall Street Week every Friday at 6 p.m. Eastern. Now, guys, I want to bring you also some breaking news that had crossed the terminal just under an hour ago, really. JP Morgan Chase, the largest U.S. bank, of course, is planning to tell all employees to come back 5 days a week. It's going to be ending its hybrid work option. Remember, JP Morgan, of course, expanding its physical footprint here in the United States, but also across the United States. It's only a matter of time, really.
Well, I mean, you think about their managing directors, they've been required to be in 5 days a week since April 2023. So I would imagine a lot of JP Morgan employees who want to move up the ranks already were coming in 5 days a week. I have to say, I hate this. I think hybrid work is the future, and people need to have lives. Yeah, I know that
it's a 5-day work week.
I feel like I have the moral authority to say that because I'm in this office 5 days a week.
Yeah, I've never worked from home. I imagine it would
You're
be
old
fun
school, man.
putting on pajamas, watching TV.
It's the best.
Going to the store,
Although
you know.
Working really hard, never logging out. That was my work from home experience during the pandemic.
It is interesting to talk about this in terms of the talent shifts because, of course, a lot of this couldn't happen if you thought you were going to lose your employees to a private equity firm or credit firm, where this is not the case. In fact, some of these rivals have policies where most of the summer you can work from Italy if you wanted to. It didn't really matter.
Does that really work?
People do it.
Yeah, people absolutely do it.
I think it's using the phrase very lightly, loosely.
It's a policy.
Work from Tuscany at a vineyard, right?
I think this is that is what's happening. Work from an island if you like, but what this does show you is that they have more control over their workforces. Of course, it's bonus season coming up, and we've seen it from some of the hedge funds and the banks already. It's culling season as well, where some people are let go, the underperformers of these banks. We will keep an eye on all of that, the talent story. But stick with us. Up next, we're going to go back to that story of the day. That is Nvidia up higher, then hitting some road bumps into U.S. economic data. But we're going to talk about the company itself next. Stick with
Down
us.
6%.
Oof, brutal. This is Bloomberg.
We used GeForce to enable artificial intelligence, and now artificial intelligence is revolutionizing GeForce. Everyone, today we're announcing our next generation, the RTX Blackwell family.
Nvidia CEO Jensen Huang there announcing a new video gaming chip, as well as a raft of other new products, software, and services at the CES trade show in Las Vegas. We'll be speaking with him in just about 30 minutes' time. Ed Ludlow is down there in Vegas, taking time off from paternity leave to do God's work. Joining us now is Bloomberg Technology co-host Caroline Hyde. She's here on the Bloomberg Tech set, and we've seen a real turnaround in Nvidia shares, not necessarily having much to do, I wouldn't think, with last night's news, Caroline, but they were up 3% at the top of the trade, and now they're down 6% after we got some broader economic data.
Also, worst day trading for it in 4 months. Maybe there is some micro within also the macro picture of the day. We're off by 5%. This is a stock that's rallied 11% before this in January alone. Maybe there's some profit taking. Maybe there's also a little bit of, disappointment. Benchmark, for example, the analysts over there that do have a price target of 190, so still see this crescendoing higher. But they felt perhaps investors were hoping for a little bit more concrete progress on the updates around the Blackwell platform. How is that selling? How is that getting into customers' hands? What about the next innovation of GPUs? Because from Jensen Huang, we got a really forward-looking, building that technology mode picture. We got the future of robotics, of autonomous driving. We got a new PC that's $3,000 for AI developers. We got new gaming products, but maybe not enough to say, look, how is the big money spinner, the AI accelerator, doing right now?
Yeah, you take a look at shares right now, down about almost 5%. That is the worst one-day intraday performance since October or so. Of course, we hit another record high this morning, so maybe what you're saying about profit taking is apt there. But talk to us a little bit more about Blackwell, because, of course, Wang has spoken about the incredible demand that he sees for Blackwell. But what is the actual timeline there?
Well, they say that they're a full product ramp right now. And so ultimately, everyone been waiting for the first quarter, the first half of 2025 to get it into their hands. We were speaking with the AWS CEO previously in December and in November, who had been perhaps saying that it wasn't getting to him as quickly as had been anticipated, but he wasn't worried longer term. This often is about the way in which technology has to iron out the kinks of the supply chain, ensure that they're able to set it up and ensure that it's running for its customers as quickly as possible. No one was worried about the longer-term ramifications of Blackwell's perhaps slower rollout than had initially been anticipated. But there is a worry that it needs to get into people's hands. The revenue stream needs to come on tap, and they need to start talking about the next layer. Remember, this is a new Nvidia under Jensen Huang that innovates every year. It's like an Apple. It's like bringing us a new GPU set, a new platform every single year. What then of the next innovations when it comes to GPUs? And indeed, we've got that steer from Microsoft. They're going to be spending $80 billion this year on AI data centers. We're not worried about demand for this infrastructure. We're actually more worried about the supply side. So perhaps a little bit more can come from the interview with Ed Ludlow in a moment about where we stand on Blackwell. But also then we want to know about the future gazing, about the moat that they're building, how they're managing to fend off AMD, which itself has announced a new relationship with Dell, how they're going to have AMD chips within their PCs and how they're going to be the best for AI on a PC. But of course, today we got the PCs coming from Nvidia too.
Caroline, we thank you so very much for your time, of course. And guys, I'm taking a look here at what is going on outside of Nvidia, because you are seeing kind of that negative attitude spill into not just the broader stock market, you're also seeing it spill into other stocks in the Philadelphia Semiconductor Index. Uber, for example, not in that index. It had a real gain this morning. It dipped into negative territory. It's back up just a little bit on the day. Micron is keeping its gains at 5% or more, but Taiwan Semiconductor Index, big supplier, of course, we know, is still down almost 3%. Before, 22 stocks in the Sachs were lower on the day. That is now much more, or sorry, 22 stocks were higher on the day. Now only 17 are. So that bad
None of them underperforming to the extent that Nvidia is.
It's incredible.
Right?
It's brutal. And you take a look, of course, at the ripple effects of that. It's not just Nvidia. You think about the economic data that we got at the top of the hour, of course, when it came to JOLTS, when it came to prices paid on ISM services. You wrap it all together. It looks like a bit of a hairy market here. Meanwhile, President-elect Donald Trump is set to make remarks from Mar-a-Lago at Palm Beach, Florida, in just a few minutes. We're going to bring that to you when we have it. But that does it for Bloomberg Open Interest. We'll see you tomorrow. This is Bloomberg.